Well, we definitely had a lot of people interested in coming today, so we're glad to have you join us. And we're looking forward to sharing some information that you probably haven't heard anywhere else. I've been teaching seminars to entrepreneurs on taxes for the last handful of years, always privately through organizations and masterminds and different communities. This is our first time doing a public presentation, so hopefully you'll find the information valuable and unusual and unique. And we look forward to sharing some information that helps you reduce your income tax. So for those of you that don't know me, I'm Noah Rosenfarb. I'm a third generation CPA. I've been involved in helping entrepreneurs achieve their financial goals since the turn of the century. It's a passion of mine, something I love doing. And over the last handful of years, along with my co-founder, Peter, we've really narrowed down the most efficient way to help entrepreneurs pay less in taxes. And we're going to share some of our insider secrets with you today, and hopefully you'll get value from it. Peter, maybe you could introduce yourself. And
Sure. Thanks, Noah. Peter Culver, co-founder with Noah, longtime warrior in the minimized tax war. Started working maybe 20 years ago. Started our company about 6 or 7 years ago. Today's program is brought to you by our company known as Wealthrive. And Wealthrive is a wealth coaching firm that specializes in teaching and implementing very powerful, unusual tax strategies to help our clients, one, maximize their wealth. That's the dollars and cents result of paying less in taxes. But using that to help you build the life you really want, what we call living rich beyond money. And the numbers can be powerful. We're all familiar with, if I invest my money and it grows at a compound rate, how that magnifies my wealth. But as the next little, oh, no, you're going to do this first. Sorry, man.
That's all right. So yeah, today we're going to share a couple of the strategies that I've used for my family. This is kind of my stack. If you think about your tech stack that you're using in your business, this is my tax stack that I'm using in my personal family situation. We'll talk about the ones that are listed in yellow, but it's a good page if you just want to take a screenshot. Again, this is what works for me. What works for your family may be totally different. Everybody's solution really needs to be custom to their goals, but I'll share with you how I built these structures and what they do for me, along with some other structures that we'll share that we built for clients and the impact that it made on them.
So in our war against taxes, we focus on all three types: income tax, capital gain tax, which could be sale of a business, sale of a large piece of real estate. We did an amazing transaction just this past year for a gentleman who sold a large holding in a stock. Noah will talk about it in a minute, but he sold what, 8 figures worth of stock and paid no tax in selling his stock. And then we'll also talk toward the tail end of today about the estate tax, which should be on everybody's mind because the current estate tax exemption, which is very high, is slated to come down. So our work is very comprehensive, and you may have issues in all three of these or only one, but love to help you in any of these areas. And we're going to unpack today some powerful strategies in each area. And while I was trying to trip on Noah's lines, just an interesting slide here. We're all familiar with the power of, in general, compound growth of assets. But if you think about, if I earn $1, but I have to pay 25 cents in tax, then I only have 75 cents left. And if you play that out over time, that's the middle column, in comparison to the right-hand column, where if I don't pay any tax and my dollar becomes $2, not $1.75, and then it doubles 5 times, 10 times, 15 times, the power, just the raw power economically of not paying taxes is very, very significant. So we'll show you some ways to take advantage of that compounding. And I think the point of this is we look at what we do as being what we call tax strategists. Most people do not rely on their CPA for tax strategies, and most people never get a call from their CPA about a tax strategy. So we're tax planners or tax strategists. We're going to show you creative and exciting ideas to reduce your taxes. We will work hand in hand with anyone's CPA. But the title of the program, which I think you'll find you'll agree with, is most of what we're going to talk about, your CPA has never told you about. So Noah will kind of kick it off and talk a little bit about how that relationship with the CPA can work with these strategies.
And one of the big concepts that we want you to be aware of is understanding your own, what we call audit risk tolerance. And that means how willing are you to take a position that the IRS might disagree with? So, oftentimes an accountant will only want to report your information in such a way that if the IRS were to examine you, they wouldn't disagree with anything you've done. And we just find in a general sense, that may not be aligned with your risk tolerance as an entrepreneur. Most of us are taking risks in our business all day long. And the way we decide to take a risk is by having a feeling or sense of what the reward is and what the downside is. And when it comes to taxes, so many entrepreneurs really are unfamiliar with the numbers. So if you're earning under $400,000 a year, your probability of an audit is 2%. If you're earning over $10 million a year, your probability of an audit is around 10%. So depending on your income, you're somewhat between 90 and 98% likely to not be audited. And so that often frames what risks entrepreneurs are willing to take when they have that data set in mind. Well, the second thing that you have to think through is if you're in the unlucky 2 to 10% that gets selected for an audit, what might happen? What are the range of outcomes? So, of course, one outcome is the IRS agrees with everything you've done and there's no change. And that happens quite often. Another outcome is that you have a disagreement with the IRS. They want you to pay tax and you've reported a position that avoided tax. And like any dispute, you have a range of outcomes. The worst possible outcome is the IRS receives 100% of the tax that they initially wanted to begin with. And so, again, if you paid the tax after an audit, and that's as a result of something that you may have just paid the tax if you filed it properly to begin with, you didn't really lose any money. The second consequence of a 100% disagreement with the IRS is they're going to charge you interest from the date that you should have paid the tax until the date that you actually pay the tax. Now, again, if you do smart things with your money, hopefully that doesn't really have a financial impact either. In some ways, it could have a positive impact if you're generating higher returns on your capital than the IRS is demanding in interest, which is typically somewhere between 4 and 8%, depending on where interest rates are. So the third outcome of a total disagreement with the IRS could be a penalty. That's really the only punitive part of a disagreement with the IRS. And penalties can be significant. And what most entrepreneurs are unaware of is that you can get a tax opinion letter, which is a letter that's drafted by a qualified expert, typically a tax lawyer. And if you have a tax opinion letter, basically saying that the thing that you did that the IRS disagrees with now, you had a more likely than not chance of having upheld. If you have that letter, the IRS cannot charge you a penalty. So your worst case scenario, if you're in the 2 to 10% that's audited, is that you're going to pay them the tax that you would have paid them had you done it the way they wanted you to do in the first place, plus interest from the date that you should have paid them. And so with that downside in mind, you may be willing to take a different tax position than your accountant. And so often when we ask our clients, that they often want to review these strategies with their accountant, the tax preparer they work with, unfortunately, there's a saying, what accountants aren't up on, they're down on. And that just means often if it's not their idea, it's not a good idea. And so when you present them with information that they haven't seen before, often you're going to get a gut reaction of, I wouldn't do this. And what we encourage you to do is ask them some deeper, more relevant, pointed questions. And those are all available in the Slash Your Tax Guide that we'll share with you at the end, that you could sign up. And maybe while we're at it, we could post the link if anybody wants to download that book while we're talking. But basically, you want to ask your accountant if they've ever advised one of their clients to participate in a tax strategy that the IRS might disagree with. And if they've never, ever done it, well, then they're probably not going to start doing it now. And you should just be aware of that as you take their counsel into the context of the advice you're receiving.